You've spent decades saving diligently for retirement, but then out of nowhere, the IRS says, congratulations, now you have to start withdrawing whether you want to or not. That's your required minimum distribution, or RMD. And if you're not ready for it, it can create a nasty tax surprise that eats into your nest egg. I'm Hunter Brockway with Boca Retirement Strategies, and today we're breaking down how to keep more of your savings when the RMD clock starts ticking. At Boca Retirement Strategies, we help retirees build tax-smart income plans so they can spend confidently, not stress about surprises. Let's look at what RMDs actually are and the smart moves that can soften the blow. An RMD is the amount the IRS forces you to withdraw each year from your traditional retirement account once you hit a certain age. Currently 73 under Secure Act 2.0, soon to be 75 for those born 1960 or later. The calculation is simple. Your account balance on December 31st of last year divided by an IRS life expectancy factor. Sounds harmless until that withdrawal stacks on top of your Social Security, pension, and other income, pushing you into a higher tax bracket. Let's talk about how RMDs can blindside retirees. I met a client, we'll call her Jane. She turned 73 and discovered her RMD was nearly $90,000. That one withdrawal shoved her from a 22% to a 32% federal tax bracket and triggered IRMA Medicare surcharges.
Today's video got you thinking about your own retirement planning. I'd like to offer you something to help you see the bigger picture. We've created a Tax-Smart comprehensive retirement workbook for pre-retirees and retirees. If there's one thing I've noticed in my years of working with individuals, it's that there's always at least one aspect in the planning process where they say, I haven't thought about that before. No matter how smart they are, how much they've saved, something comes up, whether it be they realize they can spend more than they thought they could. They realize their tax bill is going to be higher in retirement. They are going to leave money on the table with their current Social Security claiming strategy. This workbook is designed to help you walk through the most critical areas of retirement planning with action steps, false beliefs, and areas for you to input your own reflection items. You can download the workbook by going to the link below in the description. If you have any issues with that link, send us an email at contact@bocaretirement.com. If you get through this workbook and you'd like your responses reviewed or have any questions, I'm happy to have that conversation with you too. As always, this is no cost, no obligation, and no pressure. Best of luck.
Some strategies to consider to control RMD tax impact. Number one, do strategic Roth conversions before 73 or your RMD age. Convert portions early as it applies to your specific situation. This isn't individualized advice to shrink future RMD balances. Number two, use qualified charitable distributions. If charitably inclined, you can give directly from an IRA to charity, which also counts towards your RMD, but not income starting at age 70 and a half. Number three, sequence withdrawals. Sequencing withdrawals from tax diversified accounts can take a bite out of taxes. If you want to map out your retirement income and see how these strategies fit into your situation, download our free Tax-Smart Retirement Workbook in the description below. So remember, number one, RMDs are mandatory but manageable. Number two, plan early with Roth conversions and QCDs. Number three, sequence withdrawals to avoid tax spikes. By doing this, you turn a forced withdrawal into a planned income strategy and keep more for yourself and the causes you care about. I'm Hunter Brockway with Boca Retirement Strategies. Enjoy your successful retirement with more money, fewer taxes, and less stress.